Hello, well builders. Today's video is going to start with an investment quote that says the journey to wealth begins with investing, but the journey to a successful investment begins with the right decision. Tell me, your last investment decision, how did you make the decision? What were the analysis you did that informed your decision making? How do you determine the investments or investment schemes that is right for you? This is why I'm here today, and I promise you, after watching today's episode, you'll be able to make what I call informed investment decision. And I'm going to be showing you what is called investment decision process in the finance world. Stick around, guys. All right, welcome back, guys. Welcome back to my channel. This is Wealth Builders Academy, where we empower everyone with the requisite knowledge in financial and investment education in order to help maximize your true potentials and opportunities. It's amazing to have you, and thank you for watching. Today is going to be an amazing lecture, and we will be talking about how to choose the right investment for you. And this is for both small capital investors and huge capital investors. As you know, investment opportunities, or let me say, there are diverse assets in which one can invest in, but it's not every asset that is right for every investor. And this is purely financial management practice. In investing, there's what we call investment decision process. This is where you analyze, you carry out analysis on various investment projects to determine which one is right for you and to determine which one will bring the most returns on investments. All right, calm down, guys. I know some people will be thinking, oh, we are going to be going very technical and very doing mathematics and all that. No, we are not going to be doing mathematics, but we are going to be doing the very basic analysis every regular person can carry out on his or her own, and then be able to determine which investment scheme is actually right for him or her. All right, so welcome, guys, and before we dive into it, please I need your help on this. Kindly subscribe, share, like, and I need your comments. If you have suggestions on what kind of educative content on investment and finance that you would like to watch again, just go ahead and make your suggestion in the comment section, and I will be very glad to have it. So let's go, guys. This is the number one analysis we'll be carrying out as a prospective investor. And it's going to be, just ask yourself the question, what is my investment goal? What do I stand to achieve? Or what do I seek to achieve through these investment projects that I want to carry out? Am I investing because I want to realize passive income? Am I investing because I want to raise capital for a business? Am I investing for the future, or am I investing for the rainy days? Am I going into investing because I want to guide against inflation in the future, or am I investing because I want to avoid reckless spending? You have to define your goal. It is called goal-based investment planning. This is the first step you have to carry out. After asking yourself these questions and providing an answer, then you move to the next stage, which is your risk appetite. And here, when we are talking about risk appetite, every investment, whatever investment it is, carries a risk, has and carries a risk. It's just the only difference is the level of risk of one investment is different from the other, but every investment carries a risk. So if you look at this green zone here on this investment risk meter that you're looking at, you will see that, so this green zone is a low risk investment. And what are those investments? Government bonds, fixed income funds, talking about treasury bills. Those are low risk investments that the certainty of preservation of your capital with interest is there. So there's guarantee that you are going to get your funds back. And there are some other investment schemes like this that are low risk. So usually from low to moderate are always in bracket together. So you have moderately high and high risk that are separate. So when you come to the moderate risk, which is this, we are talking about commercial papers. That's when you lend money to corporate institutions and then they pay you interest on your investments. It's usually within a year, 9 months, thereabout, 270 days to 365 days, usually within a year. And the percentage is, the interest rate is usually, the return on investment is usually higher than what you have in low risk investments. So you also have moderately high risk, and there you're talking about real estate and some other investments that are a bit risky. Some people may be thinking real estate is not, it doesn't carry risk, but it does. What if you bought a land or you bought a property and government end up taking over the land, or something happen, there's a collapse or whatever? There is always a risk. And the next one, which is the last here, is high risk on the meter. That's where you're talking about trading in stocks, trading in derivatives, talking about exchange traded funds, talking about forex trading, talking about crypto trading, and the likes. So they are high risk, and they are also having probability of higher returns on investment. From the analysis here, you tend to determine what kind of person are you. Are you the type that has a high risk appetite? You have the capacity to take risk. Then this meter will help you know, okay, what section of investment you should be looking at. And if you are the type that you don't want to lose your money, you cannot afford to lose your money, you cannot afford to take risk, you are risk averse, so you tend to stick around this 2 zone and here. So that's how it works. But for those who have the higher risk appetite, you guys can play around here. So, and the best I would suggest is diversified portfolio, where you can have some portion of your investment here, and here. So that's the professional way to undo and manage risk. Let's move ahead, guys. The next on the list is investment tenure. Okay, this is where you analyze your investment project you are looking at. What is the duration for this investment? At what point am I going to get returns on my investment? Are you a short-time investor? Do you want to invest on a short-term basis? Do you want to invest on a medium-term basis? Or do you want to invest on a long-term basis? So on a short-term basis, you may be looking at investing for 3 months, for 180 days. That's 90 days, 180 days, or 365 days. Then the medium term, from 1 year to 2 years. Then for longer term, we'll be talking about 3 years to, or 2 years to 5 years investment. So you determine what tenor is the investment scheme. So that will guide you on which investment scheme to go for. So the next is your investment capital. This is a whole lot. It determines a whole lot in your decision making process. Do you have a lump sum capital already that you want to invest? If you have savings, then you have a lump sum capital that you can invest and just watch your yield. So that will give you opportunity to invest in more opportunities, more options for investment. But if you don't have a lump sum already saved capital that you want to invest with, then you may not have many options to invest in. So you might just have to invest in opportunities that allows smaller amounts based on your capacity. Next on the list is now your returns on investment. Yes, this is a major, I know this is a major determinant for others, and this is the reason why a lot of people fall into scams. As a matter of fact, many, probably 70-80% or 90% of people only base their analysis on return on investment. All right, so finally, analyzing several investment options that you have based on their return on investment will help you to determine, okay, is this 10% good for me? Is this 15% good for me? And when you see a return on investment that is very high, like proposition of 100%, 200%, then you should know that's a red flag. Within a certain time, maybe within months or within a particular period of time. Except even stock trading and crypto, forex that are high risk and all that, based on professional trading experience, they have a certain time limit before you can achieve that. So if you are looking at a high returns, looking at 100%, 200% on your investment, then you should be looking towards stocks and the high risk investment side. And if you are choosing that, make sure you are choosing it for long-term basis, not on the short-term basis, because when you are putting your money in stocks, it's good when you are investing over a long period of time, so that you will not be under pressure with the fluctuations of the market. Definitely you are still going to get that reward of 100%. It happens in stocks very well. But if you're not looking at stocks, then consider lower return on investment. So guys, this basically is how you analyze any investment you want to go into, and that is the investment decision process as explained. So this is your key takeaway in the investment decision process. What is your investment goal? What is your risk appetite? You consider the investment tenor, how much and how often you will be investing. That talks about your investment capital, and then you consider the ROI. And we've come to the end of today's lecture. Thank you guys for watching. Remember, please share, like, and subscribe. Share this to your friends and loved ones to help everyone improve their investment and financial education, and to be able to build wealth, manage, and multiply it. Thank you guys. Stay blessed.